Hey guys, hope you're doing well out there. If you wanted to know what a disastrous quarter with some serious underlying issues looks like, I present to you SBUX Corporation, ticker symbol SBUX. Not one we've covered on the channel before, but I think one that deserves to be covered after an absolutely terrible Q2 print with some serious issues. So we'll get into all of that. We'll also take a look at the stock chart, as this one is an absolute free fall. So grab your coffee. I think this one will be good. Shares of SBUX, after reporting their Q2 results earlier in the week, are down close to 18%, and year to date, not a better picture, as you have shares down close to 24%. You stretch it out further, over 5 years, you're down 6% on the stock, not even eking out a gain. And even over the past 10 years, you're up 100%. And keep in mind, that's actually not even outpacing the performance of the S&P 500. You do have some dividends that you get with a company like SBUX, but even including those dividends, your total return over the past 10 years have actually underperformed the S&P 500. So the question begs, is SBUX ready to outperform the S&P 500, or will this outperformance just continue to get worse as we move along? And that is pretty clear, in my opinion, from these Q2 results, as you have revenues coming in at $8.5 billion. That was a decline of close to 2% year over year. So you did have declining revenues, but what's worse is the fact that you missed on those revenues by nearly $600 million. That is a huge miss. In fact, the worst miss SBUX has had since the pandemic quarter. On top of that, you also had Q2 non-GAAP EPS come in at 68 cents. The estimates were at 80 cents on Wall Street. So another huge miss on that EPS side. And a lot of this speaks volumes to what management could have done, and we'll get more into that in just a second. So along the board, you had a top line and bottom line miss on SBUX's Q2 report, and then along the board, you also had declining metrics really everywhere you look. So you had global comp store sales, otherwise known as same store sales, very important metric, especially in the food industries to look at. On a global basis, you had this declining nearly 4% for SBUX. On top of that, you had a 6% decline in global comparable transactions. Basically, the number of transactions going through SBUX declining 6%. That is on a global basis. That was offset by a 2% increase in your average ticket price. So something that generally would be considered good, but in my opinion, I would actually say this 2% increase for SBUX on their ticket price actually probably more of a bad thing, considering the consumer sentiment towards the price of a SBUX drink. So we'll get more into that as well in just a second. On top of that, you had decline in your comp store sales in North America, as well as that declined close to 3%. And then internationally, you had declining same store sales by nearly 6%. The all important China market for SBUX, you had declining same store sales by double digits at 11%. So we know China has been a tough market for Tesla, for Nike, even for Apple, as we saw last week. And SBUX showing the same, that the China market really is in a tough spot at the moment. But in my opinion, I think something that could have been telegraphed just a little bit better by management, that would have gone a long way. Now, on top of that, you do have the company still continuing to open net new stores. So they opened roughly 364 net new stores in Q2 and finished the period with nearly 39,000 stores, with the majority of those, nearly 52%, being company operated. Last week did also get SBUX to announce the expansion into 2 new geographies, that is Ecuador and Honduras, and they're expected to have a store number close to 55,000 by the end of 2030. That is globally. And so when you see SBUX ending this Q2 with roughly 39,000 stores and expecting to get up to 55,000 stores by the end of 2030, that is a pretty rapid expansion in terms of store openings, in my opinion, considering you do still have some stores closing. And so these are net new stores, not just purely new stores. And as we'll see, this store expansion decision over at SBUX, in my opinion, actually not the best decision. On top of that, now we have full year 2024 guidance, which came in from SBUX, which also was revised down. And keep in mind, this was the 3rd consecutive quarter where SBUX has revised down their full year guidance. So now they're guiding full year revenues to come in at the low single digits growth, with operating margins to be flat. On top of that, to make matters worse, they're expecting full year EPS on a non-GAAP basis to now come in at flat to low single digits. And to put this into perspective, I have SBUX's Q1 report pulled up, and just 3 months ago, this was at the end of January, SBUX for the full year was guiding for revenue growth in the range of 7 to 10%. Keep in mind, just 3 months later, that has come down to low single digits. So a little bit of a decline on your revenues. Now again, 3 months later, they're expecting operating margins to be flat, and just 3 months ago, they were expecting progressive expansion on those operating margins. So just in 3 months, what has changed so drastically to reduce your revenues and your operating margins? And then to make matters worse, just 3 months ago, they were expecting full year EPS growth to come in at 15 to 20%. And a couple of days ago, now they're expecting full year EPS growth to be flat all the way up to low single digits. So keep in mind, that is a huge revision downwards, especially on your full year EPS. How do you go from expecting 15% growth on the low end to now expecting no growth on the low end in the matter of 3 months? That is something management over at Starbucks could have telegraphed a lot better to soften the blow, especially considering how much lower you're revising your full year EPS. And keep in mind, this is the third consecutive quarter of lower revisions on your revenues and EPS. At the end of their Q1, they also revised their guidance lower. So keep in mind, this lower revision comes for a third consecutive quarter. And so that begs me to ask the question, how in the world does Starbucks expect to get back to the growth of that low teens, low mid double digit growth for the foreseeable future? You see, for the full year of 2024, they're expecting just 2.5% growth on that EPS. Somehow, magically, 33 analysts on Wall Street expect this company to get back into the 15% growth over 2025, 2026, and so on. And personally, I just don't see that happening. There's nothing that I heard from Starbucks in this quarter that tells me that this company will be able to accelerate their earnings growth rapidly to the tune of low double digits, even mid double digits, suddenly moving into next year. And so really, I have my doubts about these growth rates, both on the earnings side, but even on the revenue side. How in the world does Starbucks expect to get back up to the high single digits growth moving into next year? Personally, I just don't see that happening. And so as you have these numbers being revised down, certainly from a forward price to earnings multiple, not wildly expensive, but keep in mind, for the growth rates that you're getting over at Starbucks, certainly not worth running out there and buying purely based on the valuation. Now, on top of that, I have listened to this interview on CNBC by Jim Cramer, absolutely grilling the Starbucks CEO. And honestly, if you haven't gotten a chance to listen to it, I would highly recommend. I will have it pinned in the description of this video. And it was honestly cringeworthy. It was tough to listen to. I'm not even a Starbucks shareholder, but just an absolute train wreck, and I think one that is not assuring to Starbucks investors in the slight least. Now, on top of that, I do want to discuss some underlying issues that I see over at Starbucks and what I think are some things holding this company back. Now, the first thing is that management, that includes that Starbucks CEO, needs to be more transparent and accountable. So first of all, Jim Cramer asked him, why weren't these disastrous results pre-announced? And he simply didn't have a good response for it. I don't think Starbucks goes from 15% growth on their EPS to no growth on their EPS expectations in 3 months. I think that's something they knew from before and something they could have telegraphed better. So just pre-announcing disastrous results builds a level of trust with your management team. On top of that, I think the management needs to take accountability for lower transactions and average ticket prices being lower. They do mention in the quarter that a lot of it is due to weather issues or the Middle East conflict. And in my opinion, I think that's simply not the case. I think those are excuses that management is making in order to not really talk about the major underlying issues. And lastly, they do need to make it clear if Starbucks is losing market share, to whom they're losing market share, and why that is. Jim Cramer asked a simple question that other coffee companies like Tim Hortons, like McDonald's, simply are not seeing the issues that Starbucks is and are saying that they're taking market share from Starbucks, yet Starbucks is sitting there and telling us that they're not losing market share. So clearly something is not right and something is not being accurately conveyed by Starbucks management. So I think they need to be more transparent and held more accountable for their words and their actions. Secondly, you have the most important point with Starbucks that many consumers feel is that Starbucks has stretched their pricing power simply too far. They've gone up on prices too much and way too fast. And so what that leads to is the Starbucks consumer feeling those price hikes, especially during an inflationary time, and pulling back on discretionary spending on their $6, $7, $8 lattes. And ultimately, I think this is not a consumer problem because we heard from Yum Brands, we heard from McDonald's that are not necessarily saying the consumer is weak. In fact, that's only Starbucks pointing to that. And that's largely, in my opinion, due to the fact that their lattes and their coffees are $5, $6, $7, $8. Now at a point where they've taken too much pricing and they really don't have room to expand on that, and the consumer is pulling back. So I think that's something Starbucks just simply needs to get to the fact and admit that they've taken too much pricing and they ultimately will need to pull back. Now, you also have coffee, in my opinion, becoming a commoditized market. There's simply too much in the coffee market from other fast food chains, like we mentioned, a McDonald's, Dunkin' Donuts, Tim Hortons, even Dutch Bros. And then on top of that, you have local independent coffee shops that seems like are on every corner that there's simply just too much competition. Anytime you can enter a Starbucks, you have the choice to maybe enter 3 or 4 other coffee chains right around that corner. You also have the rise of energy drinks becoming more popular, like Celsius, that is also contributing to lower consumption of coffee. Some people are choosing to move away from coffee and drink energy drinks to get their caffeine fix. And so I think both of those reasons, the fact that coffee has just too much competition in the market, and you also have other companies like Celsius taking away some of those consumers away purely from coffee, leading to more challenges, in my opinion, for Starbucks. And that ultimately comes back to the fact that you simply can't have too much pricing when you are in a commoditized market. When you have so much competition and you continue to raise your prices, at some point your consumer will realize there's just cheaper alternatives when there's nothing fundamentally different or at least better about your product. Now, you also do have the fact that the Starbucks brand and experience, in my opinion, is deteriorating. Starbucks simply is not the same experience or the same brand it used to be 10, 15, even 20 years ago. You have wait times being too long. You have products out of stock. In fact, these are two things that management themselves mentioned in their Q2 report. They said that people are getting onto the Starbucks app, they're filling out their order, but before clicking checkout, they see that the wait time is too long or that some of their products are out of stock, and they're abandoning that transaction. And so these are two real things that Starbucks themselves have mentioned that is leading to a lower conversion from, in fact, their most loyal customers. On top of that, you have the general idea that stores are not clean. Customer and employee interactions are now limited due to the high focus on drive-through and the app. Looking at Starbucks 15 years ago, the experience was you go into a Starbucks and you interact with your barista. You ask them questions about Starbucks. You talk to them, and that makes your Starbucks experience more worthwhile. Now, due to a high focus on drive-through, due to a high focus on just ordering through the app, you're likely going into a Starbucks and not actually expecting to be there for very long. And look, I actually think the Starbucks app is a good thing for the business. It sort of has allowed them to become a bank where they get a lot of deposits onto their app. On top of that, you have an extremely loyal customer base through the app, through their rewards program. But to some extent, that app has taken away from the original Starbucks experience of walking into that coffee shop and getting that Starbucks experience from your barista wearing that green apron. So I think there's some give and take with focusing on the app too much. And then lastly, you also just don't have the experience of simply sitting at a Starbucks to do your work or to meet someone, as other coffee shops can just provide a better experience for their customers. They can focus more on their customers, as you see Starbucks is sort of losing focus on their customers. And this brand and experience deterioration over at Starbucks is something consumers are seeing and realizing, and one of the reasons I think they are choosing to step away from Starbucks. Now, you also do have the limited expansion on your operating margins due to greater promotional offers. Really, anytime you open the Starbucks app, it seems like they have another promotion or another deal going on. And people using the Starbucks, like I mentioned, a great app with a loyal customer base, simply are getting more and more reliant on seeing promotional offers. And when you get to a point where you have no more room to raise your prices and you're continuing to provide more promotional offers to move through your inventory, to come out with new drinks, and you're discounting your already existing inventory, and then on top of that, you're not able to drop your operating expenses, you simply will not be able to raise your operating margins. And that's what we're seeing with Starbucks over the past. Their operating margins have declined. They've reached a point where prices are too high, they have to provide more promotions, and the operating expenses can't be brought down, and that is leading to lower operating margins. I think that is a point where they'll continue to be moving into the future. And so all of these things, if they continue, there's likely a few things that will need to be happen. First of all, the dividend will probably need to be cut. As we saw, this is a company with close to a 3.1% forward yield that has been growing, and Starbucks is known as one of those companies to consistently give you that dividend and raise it over time. But as we come over to the balance sheet in just a minute, we'll see this dividend is seeming to hurt Starbucks more than actually help it. And if this company continues to see declines in their business, that dividend will eventually need to be cut. In my opinion, a lot of investors are holding on to the stock simply because of that growing dividend. You also will have to see the slowdown in new store openings, and they'll simply have to be reduced in how many stores Starbucks looks to open. As we saw, they're expected to get to 55,000 global stores by the end of 2030, but opening a new store is simply very expensive. There's a lot of operations that need to go into that, and if Starbucks doesn't get the return on that new store opening, it will be more so a drain on the business than a benefit. And lastly, I think you have to see the CEO get booted and be replaced by someone new. Honestly, you have this company surviving on the back of Howard Schultz for a very long time, I would think that Starbucks needs to get in someone new who has sort of first-hand experience of the old Starbucks and what it feels like to be on the ground at Starbucks. And considering the disastrous interview by the current CEO, I think at some point he will also need to be replaced. So I think all of these are some underlying issues that I see at Starbucks. A lot of it is to do with their pricing power, that they've abused it too far and have gotten too stretched on the prices of their drinks. And then a lot of it is also due to competition and the fact that the Starbucks brand and experience simply is no longer what it once used to be. And we spoke about the fact that this company will eventually have to cut their dividend. That comes back to their balance sheet. This is a company sitting on roughly $3 billion in cash and short-term investments, not a whole lot. And then you also have $1.7 billion in inventories, and that counts as part of their total current assets. Like we said, if Starbucks looks to move through this inventory rather quickly, they'll have to do large promotions and large markdowns. And so you have close to $6.5 billion in current assets. That's balanced out by roughly $7.5 billion in current liabilities. So from a current ratio, not looking too good over at Starbucks. Ideally, you want more current assets than your current liabilities. This company also has a just ton of long-term debt, close to $15.5 billion of long-term debt. And over the last 6 months, you see this number has actually gone up by the tune of roughly $2 billion. So Starbucks taking on more debt instead of less at a time where the interest rates are frankly quite high. And so Starbucks on this new debt probably paying a pretty good interest rate. And so this balance sheet just on the surface doesn't look too good. You have a lot of debt, you don't have a lot of cash, and you still are sitting on quite a bit of inventory that if you want to move through, you will have to discount. And so that leads me to their operating cash flows to the tune of roughly $2.9 billion in this most recent quarter. That is still up on a 6-month basis, on a year-over-year basis. So your operating cash flows still look good, but keep in mind, this is a company that just posted disastrous results, guided continuously lower, and is paying their management more in stock-based compensation rather than less. So you also have the stock-based compensation number rising. Certainly makes me question management even more. And as an investor, that is something you should question as well. In terms of investing activities, this is a company doing roughly $1.25 billion in terms of CapEx. And for the full year, they've guided CapEx to be roughly $3 billion. So a lot of that has happened in this Q2. Year over year, this CapEx number is accelerating. And largely, I think that is due to the fact that this company continues to open new stores in new geographies. And so you're looking at a free cash flow figure right around $1.8 billion in the most recent quarter, and a lot of that goes towards your dividends to the tune of $1.3 billion. So as we said, this company continues to raise its dividend year over year. That is up, but at some point, if you're unable to grow your free cash flows at an accelerated rate, this dividend will become a large part of that. And as we saw, this is a company with roughly $15 billion worth of debt on the balance sheet, not one that they're able to pay back. As you see, they just refinanced some of that long-term debt in the most recent quarter. They do a buyback, but I think one that could be accelerated if Starbucks was in a better capital position. So from its balance sheet, not a whole lot to like, and then from its cash flows, this is a company paying a lot in their dividends. At some point, I think that will have to come down, leading to a dividend cut. So financials certainly not looking good, the overall metrics not looking good, and then overall sentiment on the existing management team also not looking good. And then to make matters worse, you have this company that just broke through, call it a more than 10-year uptrend, and that is certainly not a good sign, as you have shares coming down to $73 and some change. And the last time shares of Starbucks broke through this uptrend was during the COVID pandemic lows. But keep in mind, this was a time where the world and a lot of Starbucks, frankly, were shut down. And even during this time, Starbucks actually didn't close underneath this trend line. It gapped down, but then ended up closing on that week above this trend line. Here we have a decisive red candle closing underneath our uptrending trend line. As we said, nearly a 10-year trend that is pretty decisively broken. And honestly, the next level of support I see for shares of Starbucks is down here in this consolidation, close to, call it $62, $63 a share. That is really where I see Starbucks coming out to settle. There's really nothing in this print that told me shares of Starbucks will see a rebound, at least from this sell-off. And in my opinion, if I were to guess, I would say Starbucks will come down close to the $62 range, maybe see a bounce off at that point, but likely will enter this consolidation period once again somewhere in the 50s to 60s range. At that point, the valuation also will, in my opinion, be far more compelling, as this company certainly not growing very aggressively, still demanding a 20 forward price to earnings multiple. I think coming down to $60 a share, this price to earnings will be a lot more reasonable considering its growth rates. And so for that reason, I will stay away from shares of Starbucks. I do see more downside for this stock, certainly a lot of underlying issues, in my opinion, that do need to be addressed before I consider buying shares of Starbucks. Lastly, I do want to point out an ETF. If you still do want to gain exposure to Starbucks, I would do it through the consumer discretionary ETF, ticker symbol XLY, as you get a lot of discretionary companies like an Amazon, like a Tesla, even a Home Depot, and you also get companies like McDonald's and Chipotle, some competitors to Starbucks, and right there you get a close to 2.4% allocation in Starbucks. That is basically the maximum allocation I would provide to a company, at least at its current time, simply because I don't have a lot of trust in management and I don't have a lot of trust in them turning around the underlying issues. I would gain exposure to Starbucks through this consumer discretionary ETF. I think that has performed a lot better, up nearly 22% over the past 1 year, up close to 48% over the past 5 years. So you do get that outperformance with an ETF like this. That was my take on shares of Starbucks Corporation. Not one we've covered in the past, certainly a disastrous quarter, and certainly a ton of room for improvement over at this business. Not one I would be too excited to jump into. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.